Welcome. My name is John Osborne, and together with Ebony Holliday, we are your virtual hosts for today's presentation. In just a moment, our wealth management investment experts will share their year-end investment commentary with you. The presentation will last approximately 45 minutes, at which time they will answer questions from the audience. If you'd like to ask a question, please use the Q&A feature at the bottom of your screen. For those WebEx beginners, the button sometimes is hard to find, so you may need to navigate to it. We will collect your questions and present them to the panelists at the end of their presentation. Now please welcome David Wissinger, Senior Vice President and Senior Portfolio Manager for Mechanics Bank.
Okay, thank you, John, and thank you all for joining us this afternoon. We have a lot to talk about today. In our presentation, I will talk about the recent goings on in Washington, and there have been plenty, and also the economy. And then my colleague, Alexei Bolenkov, will talk about the COVID and give an update on the pandemic. Todd McGinley will talk about fixed income. And then finally, Kelly Gaynor will give an overview of the equities market. And then, as John said, there'll be time for questions after that. Okay, so let's get started. Next slide, please. In terms of Washington, so much has gone on. In fact, this hardly feels like a new year. So much has gone on already in the first month. The election season was very tumultuous. From November 3rd, when we actually had the elections, to January 20th, Inauguration Day, it was really uncertain how it was going to come out. Thankfully, everything went smoothly. We have a new administration, and things are progressing as they should. I guess the real surprise was the across-the-board win by Democrats. It didn't really look like it was going to go that way, but those two Senate seats in Georgia that had to go to a runoff election on January 5th, both the incumbent Republicans lost to Democrats, which gave a very slight majority in the Senate to Democrats. Very slight because the actual measure is 50 Democrats, 50 Republicans. So the vice president, obviously a Democrat, would break any ties. So the Democrats have full control of the government now, and I don't think that was really the expected outcome, but that's what happened. It changes the outlook on things a little bit, but remember that margin is so tiny that it's not really a powerful control of Washington, even though technically it is. The Democrats are in control. So far, we've seen a lot of President Trump's executive orders overturned. In fact, President Biden overturned many of them on Inauguration Day. So far, the one that's most likely to really lead to extra costs is the reentry into the Paris Climate Accord. But a lot of these things are still playing out. There are more changes to come, and we'll keep an eye on things as they go. It's early days yet, but we expect more spending to come. But so far, the markets have liked everything they've seen. Stocks have continued to go up. Yesterday's decline notwithstanding. So far, Wall Street's right on board with all of the changes. We know we're going to see spending increases, especially in the stimulus, and that's one of the things that the stock market has liked. Economic stimulus has really kept the economy afloat since the lockdowns began in March. And so more of that is good until we can get the herd immunity, which is so desperately needed in the economy. The vaccine's in circulation, people are getting it, and that'll be the key to the herd immunity, which will really allow us to get the economy fully back open again. And most of the experts are saying that we'll probably see that by summer, as long as the rollout of the vaccine can continue. So on to the economy. Next slide, please. In 2020, the expectations were that GDP would be flat. Now, we got the first look at that today, just this morning, in fact. And it looks like 2020 GDP will come in at about a decline of 3.5%. There will be revisions to this as time goes on. By the end of the first quarter of this year, we'll probably know exactly what it was. But now, instead of just flat, it looks like the economy declined by about 3.5% in 2020. In the fourth quarter of 2020, estimates were an increase for the fourth quarter of 4.2%, came in at 4%, just a little bit below expectations. So we had that huge rebound of 30+% in the third quarter, which was really just an offset of a decline of about the same amount in the second quarter. All told, we're going to have slight decline in GDP in 2020. Looking ahead to 2021, we're seeing estimates of maybe an increase of 6%, maybe as high as 8%, probably depending on when we can get to herd immunity and really get the economy open again, and COVID finally is in retreat. So that remains to be seen. What we see causing that really is this pent-up demand in consumer spending. Remember, consumer spending is 2/3 of GDP. So when that really gets going again, we think we're going to see a really good GDP number for 2021. It's all good news, really, depending on when, as I said, herd immunity takes effect. But it's worth remembering that there's about $20 trillion in debt right now, and that debt pile is growing. Even though the stimulus is needed, that adds to the debt. So it's a little bit like the monster in the closet. It's quiet now, but we're keeping an eye on the effects of that. Could be inflationary. That's another thing we're keeping an eye on, but we're not seeing it right now. And yesterday, the Fed ended its meeting, and Jerome Powell was giving his comments. He talked about economic uncertainty because of COVID. That's no surprise. We've all known that. He broadcast and reiterated no change in interest rates in the foreseeable future, maybe through next year, and also reiterated that there would be more bond buying, which is quantitative easing, another way to stimulate the economy. So no real change from the Fed. Okay, next slide, please. This chart shows the money supply. It's measured by M2, which is liquid money in the economy. And you can see the effect of the recent stimulus and quantitative easing. It makes what we saw back in the 08-09 era look small by comparison. There's an enormous amount of stimulus in the economy right now. And you would think that would be extremely inflationary. In fact, that's the concern. But we haven't seen much inflation at all yet. And on the next slide, we can see why. So this chart shows the velocity of money, which is really just how fast money changes hands in the economy. The faster money goes through the economy, the more economic activity there is, and the better economy we have. So right now, the velocity of money is very slow. Easy to see why. Nobody's doing anything. Nobody's traveling. Nobody's going on cruises. Nobody's dining out. Nobody's doing anything. So when that picks up, and there seems to be an incredible amount of demand for it, but just the inability to do it because of COVID, we think there's going to be a huge influx of consumer spending, which, as we said, is 2/3 of the economy. So that's when the economy will pick up, and that's when we might see some inflation. Next slide, please. This slide shows the correlation between the money supply and CPI, which is the Consumer Price Index, which is how inflation is measured. So it's not a perfect correlation, but it's pretty close. So you can see the enormous increase in M2, or the money supply, and a little tick down in inflation, and that's the fact that the economy isn't really open and moving yet. So we expect to see some inflation when that begins. And that would be the key for the Fed, to start raising interest rates to try to slow things down. That's going to create a headwind for stocks, but it's not going to do it yet. It's probably not going to do it this year, may not even do it next year, but it's something we're keeping a close eye on. Okay, next slide, please. That's the end of my portion. I'm going to pass this on to Alexei Bulenkov now for an update on the COVID pandemic. Alexei?
Thank you, Dave. All right. Well, my part of the presentation was very challenging as far as putting the slides together because the information changes as we speak. But let's do a little recap on the virus itself, and let's talk about a little bit how it affects the economy and what the implications are in Washington and elsewhere. So on the next slide, we are looking at the average daily new COVID cases per 100 people. So globally, we now have over 100 million cases of COVID. In U.S., we're at 300,000. 300,000 tests were administered, and 25 million cases were detected. 107,000 people are currently hospitalized, which is a horrible, horrible number. But the silver lining is that the hospitalizations have been down 15th day in a row. So if we look at October, we had 36,000 people with COVID-19 in the hospitals. On January 13th, that number skyrocketed to 230,000. So now we're back. Below that number, 207, and that number is declining. That is encouraging. What's not encouraging is that the cases of COVID have become very, very localized. So from one state to the next, from one municipality to the next, much like real estate prices, the occurrences are very variable. So here we have national data. On the next slide, we move on to California data. And in California right now, we have about 55 cases per 100,000 people, which is less than what it was, but it's also highly localized. So LA County Health Department, for example, reported that since the beginning of the pandemic, every third person had been diagnosed with COVID. This is a very alarming number. This is not as bad as Arizona or some of the other states, but California currently administered close to 41 million tests. There has been 3.1 million cases detected. 17,000 people are currently hospitalized, and 38,000 people have not survived. If you're wondering why the numbers that I'm talking about do not match the numbers on the screen, that is because it's been 2 days since I updated those slides. So this is how fast and how this is the progression of the virus, and this is how fast the data is changing. The deaths from COVID in 2020 are now the third leading cause of deaths. So right next to cancer at 600,000 and heart disease at 584,000. COVID death accounted for 336,000 nationwide. So this is not just another flu. The problem is still very serious, and the COVID deaths combined are more so than from stroke and from diabetes. So this is very alarming. So on the next slide, I just have a sampling of the different headlines that are just coming at us with the speed of light. So when I put this together, the big deal was the slowdown in hospitalizations. There was a South African variant which has now been detected in South California. Some reports are saying that we have undercounted the actual cases in New York, for example. The vaccine is being administered, but we don't really have any federal data. As of December 20th, there has been 9.2 million doses of vaccine administered by Pfizer. Moderna administered 7.3 million vaccines, and then various other accounted for about just 4,000. The U.S. administration has announced that they will be buying enough vaccine doses to vaccinate pretty much the entire population and have the herd immunity by summer. So now we're looking at September as the V date for the victory over the virus. In the meantime, Washington has its own means of dealing with the fallout of the virus. And the biggest piece of the puzzle is the $1.9 trillion COVID relief package provided by the Biden administration. there is disagreement on Capitol Hill between the Republicans and the Democrats, mostly. The Democrats are saying the best thing we can do right now is act big and act fast and pass the relief. And the Republican lawmakers kind of saying that this might be too much and too soon. So to recap some of the proposed elements of the $1.9 trillion stimulus. So the direct payment of $1,400 to most Americans, which brings the total relief to $2,000, including the December payment of $600. The proposal has the increase in the federal per week unemployment to $400 and extending it through September, which is a meaningful deadline for when the herd immunity is supposed to be reached. Increasing federal minimum wage to $15 per hour, extending the eviction and foreclosure memorandum until, actually through September. $350 billion in state and local government aid, $170 billion for K-12 schools and institutions, $50 billion towards testing and vaccine education and awareness, $20 billion towards partnership program with states, localities, and tribes, and some other things. For example, making child tax credit fully refundable and bringing it to $3,000 per child. So there's a lot going on as far as legislature goes, and there's a lot of debate on who exactly and how this will be passed. All of this is happening against the background of Joe Biden administration and his rhetoric about healing and reconciling the nation and bipartisanship. So the passing of the stimulus bill can be done in two ways. One is by bipartisan support, which has been a big challenge, and we're not really optimistic about that's happening. And on Thursday, the House Speaker Nancy Pelosi said that they would vote on the resolution next.
Okay, thank you, Alexei. I think we're going to move on to the fixed income presentation at this point. Hello, everybody. I'm Todd McKinley, CFA and Senior Vice President Portfolio Manager. I'm going to be talking about the bond market, which is also known as fixed income. So if we look at the next chart, we can review the path of fixed income for next year. This past year, we see the path on the top line of the investment grade corporate bond market. The next line is the dark black line, which is the aggregate market in fixed income, which includes mortgages and treasuries. And then the next line shows the path of the California municipal bond market. And then the bottom line is the high yield bond market, which is corporate bonds. You can see over the course of 2020 that there was a lot of volatility in the spring. You saw some significant liquidity-seeking activity on the part of dealers and institutional investors trying to sell whatever could be sold in the face of the oncoming pandemic. And so bonds did decline rather precipitously right there at the beginning of March and through towards the end of March. Bonds do serve as an important diversifier for portfolios, and so the fact that they went down is not a concern. They did go down less than the overall stock market did, and then they turned around, as you can see on the chart, very quickly once the Federal Reserves indicated that they were going to be providing ample liquidity to the bond market, and so stability returned very quickly to the majority of the bond market, with the possible exception of the high yield market. There was some apprehension about an increase in defaults and bankruptcies in the high yield market, which actually turned out not to be the case. Bankruptcies and defaults this past year were actually less than average. So the overall corporate bond market turned in a good year. The overall corporate bond market turned in about 10% rates of return for the year, which is really very good. The aggregate bond market, again, which includes treasuries and mortgage bonds and corporate bonds as well, turned in just about 7%. Municipal bonds turned in about 5% for the year. And then high yield bonds did recover as they made their way through the year and did also return about 5% for the year. So it was actually a pretty good year, not just in the stock market last year, but it was also a good year in the bond market. Looking forward in terms of prospective returns for the next year, one of the things that you want to look at is inflation. And we've heard, we can see inflation on the next slide. We've already heard from Dave a little bit about inflation, and so there are some reasons to be concerned about inflation. What you see here is the monthly expectation for inflation for the year 2021. We do think that there is going to be a pop in inflation. Inflation currently is running around 1.5%. And inflation actually for quite some time in the past has been steadily at that 1.5% rate of inflation. But we do expect it to go up to about 2.5% starting in April and May and June. And the reason for this is because we will be 1 year over the pandemic lockdowns from last year. And when the economy went down into lockdown last year, we saw a big decline in inflation. Prices fell, kind of across the board as companies were trying to generate some kind of activity by lowering prices. So the year-over-year comparison is known as a base effect. And so in blue, you can see the base effect, which is the increase in inflation that's due to the fact that we're lapping a very low period of inflation last year. But we want to highlight that it is not likely to continue. Once the base effects are gone, we expect inflation to return to 1.8, 1.9% for the rest of the year. So although inflation may be creeping up a little bit, and there's reasons to be thoughtful about the possibility of inflation in the long term due to the money supply that David was talking about, we're not expecting that really to show up this year. And there's a number of things that the Fed can do to reverse that money supply as well. So the future path of inflation is not set in stone by any means. The other thing that you want to look at when thinking about prospective fixed income returns is the current rate of interest that you can see in the market. So on the next slide, we can see the path of the 10-year Treasury yield. And so this is actually a 35-year chart. So this gives you a long-run point of view and perspective for the 10-year Treasury yield. And I'm showing you the 10-year Treasury yield because it is the benchmark bond in the bond market. Most bonds, in fact, all bonds are priced relative to their corresponding treasury. So a corporate bond, Apple, GE, Honeywell, whatever the case may be, is priced using the treasury bond and then adding a spread on top of that to compensate for the corporate risk for the company in question. So if you look at the Treasury yield, you can get a really good sense as to what's happening for rates for the overall market as a whole. And you can see, in fact, that rates have been declining pretty steadily over the past 35 years. The red line, and that goes down right in the middle of this chart, is the average It's the mean of the yield for the past 35 years. And then there's bands on either side of the average that are the green bars. Green bars that portray the upper end of the band and the lower end of the band. And so usually when you have a recession, yields decline to the low level. And then when you're having an overheating economy, the interest rates are usually at the high end of the band, and then they decline back down again. So coming into 2020, we see that the 10-year Treasury yield was a little bit under 2%. It was about 1.9, 1.8% coming into 2020. And then once the pandemic took full hold of the economy, there was a tremendous amount of buying that went into the Treasury market, not just from institutional investors, but also from the Federal Reserve. And interest rates on the 10-year Treasury yield were pushed to a historic low of 0.5%, which is astonishing, practically zero, right? The yield was not only low in an absolute level, it was low in a relative level too, because you can see that the yield was pushed out of the trend that had been established over the past 35 years. Now, as we are approaching the end of the pandemic, the yield in the 10-year Treasury market has begun to return to a normal level. It's about 1.1% now. That doesn't perhaps feel like a normal level to most of the people listening to this presentation. It still seems like an awfully low level of yield, especially when you compare it to historical rates that were 4, 5, 6%. But when you look at that trend, you can see that what is normal is on the steady decline. We could go a little bit higher in terms of yield. The average yield right at the moment would be something like 1.5%, but we're probably not going to, because the Federal Reserve has committed to continue to buy a tremendous amount of Treasury bonds and other bonds as well, which is going to keep the rate of interest in the bond market on the low side. So the way to think about this is that if you were to buy right now a 10-year Treasury yield, a 10-year Treasury bond, you would get a yield of about 1.1%, and you would get 1.1% income each year for the next 10 years. And so that creates the base yield that you're working with when you're buying bonds. So that's at a very low level. And if you recall the prior slide, where we said that inflation at the moment was around 1.6 and might end the year at 1.8 or something like that, the inflation reflects an erosion of your purchasing power. So it's important to try to achieve 1.8, 1.9% just in order to keep your purchasing power, keep the value of your dollar steady. And so if you compare that number to the yield here on this chart of 1.1%, you can see that the 10-year Treasury yield is not currently keeping up with inflation. And so we are very careful to take that into account when we're buying bonds so that we achieve a sufficient yield when we're buying bonds so that we combat inflation and have a net positive real rate of return. But it is nonetheless going to keep rates of return in the bond market and the fixed income market on the low side for a little while to come. If we turn to the next slide, we can see the effect of the Federal Reserve's bond buying. Back in 2007, you can see on this chart that the Federal Reserve's balance sheet, and by that I mean how many bonds, what is the volume of bonds that the Federal Reserve owns and has in their vault, bank, whatever way you want to think about it, was about 6 or 7% of the overall value of the economy, and it was been pretty steady prior to that. And then when we had the financial crisis in 2008, the Federal Reserve began the process of quantitative easing, which meant they were buying bonds. And so the size of the Federal Reserve's balance sheet expanded rapidly, doubled from 6 or 7% to 15%. And then in support of the economy, the Fed continued to expand their balance sheet until 2014, 2015, where the size of the amount of bonds that they had in their vault or bank, or however you want to think about it, account maybe, was 25% of the overall economy, which is a very large proportion of bonds that the Federal Reserve was holding. And so they began the process of tapering. This was the great taper that the Federal Reserve did in 2015 through 2019. This was an attempt, since the economy had mostly recovered, to get back to a more normalized balance sheet level. And then, of course, the pandemic hit, and the Federal Reserve said that they were going to do whatever it takes to support the economy. And so they started buying bonds like crazy once again. And so they once again doubled the size of their balance sheet, taking it from 17% to 35%. So 1/3 of the value of our economy, which is $19 trillion, is sitting in bonds inside the Federal Reserve, which is an awful lot of bonds. And they have said that they are not even thinking about doing anything to reduce the size of their balance sheet. So they have, provided tremendous support to the economy, keeping interest rates very, very low, and thereby, with interest rates being very low, supporting the economy so that companies can fund their operations as inexpensively as possible. So as long as the Federal Reserve is doing this, there really isn't much in the way of an expectation for interest rates to move substantially higher. Inflation may well suggest a higher rate of interest would be appropriate, given what's happening to inflation, but the Federal Reserve is not going to tolerate that from happening. And so as long as the Federal Reserve is buying bonds, we can expect yields to remain exceptionally low in the fixed income world. So the next slide just sums it all up. You can see that rates are low, but believe it or not, that is normal now, and we should be getting used to rates being at this low level for a while, for quite some time, actually. And so just the fact that they're low doesn't necessarily mean that they're going to be going higher. And the Fed is going to make sure that that's the case. They're going to keep buying bonds, and they're going to keep interest rates low in the economy. Bonds did turn in a good rate of return last year, which is fantastic. But we can expect bonds to be stable in terms of yield, but providing a relatively low rate of return for the next year or two. We're not expecting by any means any increase in default rates or credit problems, but the overall rate of return will be low, and bond values should be stable as a result of that. So that's the review of the bond market and our expectations for going forward. And so now I'm going to turn it over to my colleague, Kelly Gaynor, who is going to talk about the equity market. So it's all yours, Kelly.
Thank you, Todd. Before I get started, though, I'd like to just remind our listeners, if you have a question, you can submit that through the Q&A button. Today, I'm going to speak about the equity markets in last year, some of the economic data that we think is important for our outlook, and the biggest risk for investors. On the first slide, I wanted to just make a note that 2020 wasn't all bad, although it may have felt that way. And we're all happy to see it in the rear view mirror. But some really incredible things happened that show how individuals and companies adapted to the pandemic that, in our lifetime we've never seen. We had multiple vaccines developed in record time. And history will show you that to successfully develop a vaccine, it takes probably 10 to 12 years, and this, of course, was done in less than a year, so that's remarkable. We also had the highest GDP growth ever recorded. The third quarter last year, GDP was up an unprecedented 33.4%. And then, of course, we experienced one of the shortest recessions and fastest recoveries last year, and all the while, at the end of the year, remarkably so, the S&P 500 posted a return of almost 18.5%. Now, this is important to remember that last year at one time, the S&P 500 was down 34%. So you know that it wasn't easy. And at the bottom of this slide is a chart showing the volatility, or the VIX index. And you can see where that huge spike is, that was in reaction to the virus. The next slide I'm going to show, actually it's a slide that we had in our last presentation, which was in early November. At that time, I had included returns on equity markets through October, so the first 10 months of last year. Looking at it today, it's incredible. Does it surprise everyone how much the markets turned and produced in the final 2 months of the year? We saw the S&P 500 go from 2.8% at the end of October, and I'm telling you, we were happy to have that 2.8%. But in fact, we closed the year, as I'd mentioned, up almost 18.5%. The Russell 2000, which is the smaller companies, had a return at the end of October of almost negative 7%. This index was the one that turned the most and had the best return during the course of last year at up 20%. The developed international market, as represented by the MSCI EFA index, was down 10.5% and yet closed the year up over 8%. And emerging markets, too, even though they had a slight positive return at the end of October last year, were up almost 19%. And again, I go back to that. During the course of the year, the S&P 500 was down 34%. This is all because of the vaccines. It's what a difference a vaccine makes. And the next slide is also a slide I'm bringing back from our last presentation. At that time, we spoke quite a lot about how markets performed under different parties in the White House with a split Congress. But since then, the Georgia Senate races have been decided in a way that I think surprised many. So I wanted to bring this slide back and just emphasize that over the last, from 1950 through 2019, when a Democratic president was in the White House and we had a Democratic Congress, the average annual return on the S&P 500 was over 14%. So this is just to show you that the data suggests you shouldn't be overly concerned. Our next slide is showing some charts with different economic conditions that are present in the market that do well for stocks. First is the Fed funds rate. It's very low and expected to stay that way. Both Todd and Dave spoke of the low interest rate environment we're in today. Also, we have a chart with inflation. They mentioned that as well. We're in this low inflationary environment, and there's no expectation for it to have to rise anytime soon. If there was such a sudden or unexpected occurrence of inflation, that can certainly have a dampening effect on the stock market short term, but as I said, not in the forecast. We also have a chart here for the ISM Manufacturing Index, and that's a key indicator of the state of the economy. In December, that index came in with a read of just under 61. 61 is well above the expansionary level of 50. And not only was it higher than that expansionary level, but it was also better than what was expected. And then the final chart there is the earnings for the S&P 500 since 1988. The last three bars on the right are showing the estimates for 2020 earnings, for 2021, and also for next year. And you can see that the 2020 earnings, well, it is an estimate, even though the year's over. We are now in the fourth quarter earnings season, but the expectation is that earnings for last year will be less than what they were for 2019, and that is no surprise given the pandemic. But you do see that for 2020, this year and next, the expectation is that earnings are going to recover nicely. Next, we have a chart showing you our current view, given where we are with the economic data on the previous slide and the accommodative Fed, and also where we are in the economic cycle. We favor stocks versus bonds. And in the stock market, we do favor large cap companies, but we also see the place for small companies, and they finally, as you saw in one of the earlier slides, had a very nice return last year. We also look at and favor emerging international markets as compared to the developed international markets. And in terms of growth and value style investing, we think a core strategy can make sense. Are there risks? Yeah, there always are, and it could be that any of the economic indicators I talked about earlier, if they reversed, the markets could react. But it could also be even something so benign as reversion to the mean that could have an impact on markets, because last year, I've mentioned, we were up 18.5%. The year before, in 2019, the S&P 500 was up over 31%. And if you compare that to the average annual return over the past 95 years, that was 10%. So you can see just the reversion to the mean might have an impact here. But we still think the biggest risk to the economy is continues to be COVID, the continued popping up of new variants, the potential for lockdowns in the economy, and of course, any kind of way we do the rollout. If there should be a stumble, that could impact things as well. But those are the risks we see to the economy, and but yet we see risks to individual portfolios as just almost always being self-inflicted. And it's when investors sell during down markets. And we saw that certainly last year. If you turn to the next slide, this is the what we call ROMO, the risk of missing out. So the biggest risk to investors is not being in the market. If an investor were in the market and was able to stick with it for the years from 2000 through 2019, their average annual return was over 6%. When those investors became fearful and left the market, if they missed just the 10 best days during that 20-year period, their return was cut by more than half. And even though this data is pre-COVID, there's always things to worry about in the market, always things that make investors scared and react and do things at just the wrong time. So if you look at this chart as you go across the page, the more time you miss in the market, the worse the returns are. The final bar is just showing you if you miss the best 50 days in this time period, this 20-year time period, and there's over 5,000 days. But if you miss the best 50 days, your return was down over 5.5% per year. So it's important to note this because last year, in 2020, $253 billion left equity funds. And our guess is probably at just the wrong time. But what's important, we'll see on the next slide, what matters most is where we are in the economic cycle, the monetary policy, and asset allocation for individuals. So in terms of the economic cycle, the chart here is showing the first three quarters last year GDP reads. Dave mentioned, received the first print for fourth quarter of this year, but the first 3 quarters we saw down first quarter and down big second quarter. We mentioned that the third quarter was up tremendously. So this is showing you that we're out of a recession and we're at the beginning or early stages of economic recovery. That's favorable for stocks. In terms of monetary policy, I have quotes from the Federal Chairman, Jerome Powell. Todd mentioned part of it earlier, but the full quote from Chairman Powell in June was saying, we're not thinking about raising rates. We're not even thinking about raising rates. And then even earlier this month, Chairman Powell said, when the time comes to raise interest rates, we'll certainly do that. And that time, by the way, is no time soon. So he said that on January 14th. And then lastly, I mentioned it, but asset allocation matters most because we saw in the last slide, if you are an investor who misses the 10 best days, you have a dramatic impact on your returns. And so even a perfect plan only works if you can stick with it. At this point, I'll turn it back to John for question and answer.
Thank you, Kelly, and thank you, panelists. I'd like to bring you all back. We do have some questions. First up is, what is the outlook for stocks in 2021 with some very overvalued? Looks like a repeat of the dot-com bubble.
I'll take that one, John. Actually, in our last week's weekly comment, we did share our view for stocks for this year and also touched on valuations, the bubble you mentioned. So if you didn't get a chance to read it, I think you might want to. But essentially, we think, as I've mentioned here, conditions are in place to produce positive returns this year, although it could be a little lower than the average annual return. And although there are definitely some areas of speculation in the market, and we've seen that on the news these last couple of days, there are conditions here that we favored the market, right? So it's hard to ignore that we're in an economic expansion. It's hard to ignore that company earnings are recovering and expected to increase. The low interest rate environment, we've got plenty of liquidity. We've got a stimulus package that likely will be out soon. And then finally, most importantly, vaccines. So it's really actually hard to be pessimistic here.
Okay, thank you. Next question from the audience. What sectors of the economy do you think will be hit hardest by the new Biden administration? And what tax changes do you anticipate from the new administration?
I'll do that one, John. I think Kelly did a pretty good job in her part of the presentation of mentioning that politics doesn't have much to do with equity performance as we think it might. I'll give you an example. Between the Obama administration and the Trump administration, if you can think of two philosophically different administrations, more than that, let me know. But between those two administrations, the same two sectors were the best performers. And those two sectors were technology and energy. So you can have dramatically different points of view in Washington, and it doesn't always affect stocks the way you think. As far as Obama's administration goes, it's a little too soon to really pick the winners or losers because we don't know what all the policies are going to be. But generally speaking, areas that look to benefit are clean energy or renewable energy as opposed to, the old school fossil fuels. Infrastructure type businesses. And so those are the ones that look like winners right now, and it's a little hard to pick beyond that. But as time goes on and more and more policies come out, that picture is going to become a lot more clear. As far as taxes go, Biden has been pretty clear he wants to raise taxes. This tends to be a little bit of a drag on the economy, but taxes were higher under Obama than Trump. But stocks did pretty well in both administrations. So I wouldn't put too much emphasis on that until we know exactly where tax increases will come.
Okay. Okay. So kind of a little bit of a follow-up to that is if there are tax changes, the question is, can they be reversed in the future or will they be permanent?
Well, yeah, they can be reversed. Tax policy comes and goes with different administrations, and what they're trying to either reward or discourage, and other reasons too. But yeah, tax policy changes all the time, and that's one of the things that drives businesses and investors crazy. Trying to plan ahead for taxes and knowing full well that they're going to change. So there's no permanent tax change.
Okay. All right. We did have a question that came in kind of related also to the change of administration, change in possible tax laws, and what impact that those might have on estate planning.
I'll take that, John. So the best answer is we don't know. It's unclear at this point. And also, even when it becomes clear, the best answer is always to talk with your estate planning attorney or CPA. But that said, during the campaign, there were two possible changes that got a lot of attention about reducing. One was reducing the estate tax exemption, and the other was to eliminate the step up in cost. So the estate tax exemption, that's the amount that a person can gift during their life or pass after death without being taxed. And that's currently between $11 and $12 million per person, and it gets adjusted for inflation. So the provision, though, in the current law is that will sunset and drop to $5 million as an exemption per person in 2026 if nothing changes. So the Biden plan, as it has been talked about or suggested, was that there's talk that they would want to reduce the estate tax exemption to $3.5 million. So that would be a big change. And then in terms, another big change, if it would happen, would be as I mentioned, the change to the cost basis adjustment. So that's when you die and you pass your assets on to your beneficiaries. Then the beneficiaries, the asset cost, the tax basis for those assets gets stepped up to the current market value for those assets. So if the plan is proposed to change that, to eliminate that step up, what would happen is the beneficiaries would receive, or inheritors would receive those assets, but also receive the cost basis at the same time. And so that can be difficult that could mean a difficult time or an additional capital gains tax down the road. So, but I have the caution is, first of all, as I said earlier, we don't have a clear plan. Not only that, we're not attorneys or CPAs, but also I think that initially this is on the back burner because the administration is going to really focus on COVID and stimulus. So at such time when it does become to the front burner, it may even change from the way it's been looked at so far. So as Dave said, yes, there's always potential for change.
Great. Thank you, Kelly. A couple more questions that came in during your presentation. Does wealth management at Mechanics Bank utilize and or recommend any options strategies to mitigate or reduce volatility within the client portfolios?
I'll take that, John. We don't use options in our portfolios. They can be good ways to hedge, but the thing about options is they have expiration dates. So once you've purchased an option, for example, unless you sell it before the expiration date, it will expire worthless. So it adds an element of leverage and a certain amount of risk to a portfolio. On the one end, it can be a hedge, but as Kelly said so well in her part of the presentation, the best hedge is to stay invested and let the inevitable downdrafts of the market come and go, stay invested in good securities, and the portfolio will do fine. which is why
Great.
we don't use them in our portfolios.
Okay. And a follow-on to that, what is the Mechanics Bank Wealth Management's approach to including any high-yield corporate bonds in the current environment to capture more yield?
I'll jump on that. So high yield is an area where diversification is extremely important. Similar to a portfolio of stocks, it's important to have a very diversified portfolio if you're going to be using high yield bonds in case any one of them should happen to have a credit event. So a fund, provided by one of the major fund families, is a potentially useful thing to include in a portfolio to enhance the overall yield of the bond portfolio for a client. The nice thing about a fund is that there's broad diversification that is happening within the fund because they own a large number of positions, and there's a active research effort that is going on to research each one of the different positions inside of that fund. So that is definitely one of the tools that's available to be used in a portfolio and would be implemented on a case-by-case basis.
Okay, thanks, Todd. And I actually probably have our last question is one that you're probably going to want to take, which is please comment on the recent events concerning GameStop.
Boy, this has been a super interesting story this past week, isn't it? The situation with GameStop, in case there's one person on this presentation that hasn't heard what's going on with them, is that a chat room a large chat room decided that they were going to individually and collectively buy the shares of GameStop and force institutional shareholders that had sold the stock short to cover their short positions, which is more buying, and it has the effect of pushing the stock price up. So 9 months ago, GameStop was at $5. At the beginning of this year, I think it was at $15. And in the wee early hours of this morning, GameStop was at $450, which is a mind-boggling rate of return. So the problem is that GameStop is probably going out of business. The business of selling physical games is no longer needed. Particularly in a pandemic, you can buy all of your games online and have them delivered to you in seconds. So there really isn't much need for GameStop. I suspect it will probably be a gradual decline because, people still do need to buy consoles, and there's a console upgrade cycle every now and then. But there really isn't much point in having a physical store any longer. So they'll probably just have an online store. And I suppose closing all the actual stores will reduce their real estate overhead. So that's all good. But the important thing here, I think, to keep in mind is a saying from Benjamin Graham. And he said, in the short run, the stock market is a voting machine. And certainly we're seeing a lot of people vote to push the stock up. But in the long run, the stock market is a weighing machine, which means that the stock market weighs the sum of the assets of the firm and assesses the value based on the mass, if you will, of the company, not so much the votes of the masses in the short term. So, we're not using GameStop in any portfolios, but because of this amazing appreciation, GameStop is now the number one holding in the Russell 2000, the index. So anybody that has an index fund of the Russell 2000 now has a piece of GameStop. And the same thing about the S&P 600. It is the largest holding in the S&P 600. And so people who don't think they have a position in GameStop might actually after all.
Great. Thanks, Todd, and thanks, panelists, for your time today. We really appreciate it. It was a great presentation. We'd also like to thank everybody who attended, and we really appreciate your time today. And please be on the lookout for future WebEx presentations. More to come. Thank you and have a great day.